All right, everyone, welcome back to the AG Insider. I'm Captain Silver, and we need to talk about what is happening right now in the silver market, because while the mainstream financial media is obsessing over gold pausing at the $5,180 mark due to rising bond yields, they are completely missing the explosive anomaly happening right now in the silver market. Silver is officially decoupling, breaking past $87 and ignoring the strong US dollar. A silent industrial panic has begun, and the paper silver illusion is cracking. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. But let me ask you right now, are you noticing physical silver shortages at your local coin shops yet? Or are the premiums still holding steady? Let me know your boots on the ground report in the comments below, because I need real-time intelligence from people who are actually in the market, not sitting behind a desk on Wall Street. Let me break down the core mechanics of why silver is surging today, because this is absolutely critical to understanding what's about to happen. Unlike gold, which is primarily a monetary safe haven that central banks hoard and wealthy individuals buy for wealth preservation, silver is the irreplaceable backbone of modern industry, technology, and military defense. Silver has the highest electrical conductivity of any metal. It has the highest thermal conductivity. It's antimicrobial, which makes it essential for medical applications. It's used in solar panels, in AI data centers, in electric vehicles, in 5G infrastructure, in defense systems, in electronics manufacturing, in water purification, in photography, in mirrors, in batteries. The list goes on and on. Silver is not optional in the modern industrial economy. It is absolutely essential. And right now, industrial users are panicking. Now let me explain what's driving this industrial panic. Right now, the Strait of Hormuz is functionally impassable due to the escalating war in the Middle East. This is creating the largest supply disruption in history. The Strait of Hormuz is not just an oil choke point. It's also a critical route for shipping refined metals, chemicals, and industrial components. When you disrupt the Strait of Hormuz, you disrupt the entire global supply chain for industrial materials, including silver. On top of that, the United States is launching massive Section 301 trade tariffs against major global economies. These tariffs are targeting China, Europe, and other manufacturing hubs, and they're creating massive uncertainty about the future availability and cost of industrial materials. Industrial giants are terrified of supply chain collapse. They saw what happened during COVID when supply chains broke down and they couldn't get the materials they needed to manufacture their products. They saw factories shut down, they saw production lines stop, they saw revenue collapse, and they are determined not to let that happen again. So what are they doing? They are not trading paper futures on the COMEX. They are aggressively hoarding physical silver right now to guarantee their manufacturing survival. This is not speculation. This is not investment. This is survival. These companies need silver to operate, and they are buying every ounce they can get their hands on before the supply runs out. Let me give you some context on the scale of industrial silver demand. According to the Silver Institute, industrial demand for silver was over 600 million ounces in 2023, and that number is growing. Electronics manufacturing alone consumes over 280 million ounces per year. Solar panels consume about 140 million ounces. The rest goes to automotive, medical, chemical catalysts, brazing alloys, and other industrial applications. Now, global silver mine production is only about 830 million ounces per year. That means industrial demand alone is consuming over 70% of total mine production. Add in investment demand, jewelry demand, and silverware demand, and you have a structural deficit. The market is consuming more silver than is being produced, and that deficit is growing. Now let me explain what happens when industrial users start panic hoarding. When a major electronics manufacturer or a solar panel producer or an automotive company decides they need to secure a 6-month or 12-month supply of silver to protect themselves from supply chain disruptions, they go directly to the refiners and the mints, and they lock up supply with long-term contracts. They bypass the COMEX, they bypass the ETFs, they go straight to the source, and they secure physical metal. And when multiple companies are doing this at the same time, which is exactly what's happening right now, it creates a massive vacuum in the physical market. The available supply of physical silver gets sucked up by industrial users, and there's nothing left for the retail market or the investment market. This massive industrial vacuum is draining the COMEX vaults. Let me explain how the COMEX works, because most people don't understand this. The COMEX is a futures exchange where contracts for silver are traded. Each contract represents 5,000 ounces of silver. Most of these contracts are cash settled, meaning no physical metal changes hands. But a small percentage of contracts are settled with physical delivery, and when a contract holder stands for delivery, the COMEX has to deliver physical silver from its vaults. The COMEX vaults have 2 categories of silver, registered and eligible. Registered silver is available for delivery. Eligible silver is in the vault, but it's not available for delivery. Over the past few years, the amount of registered silver has been declining dramatically. We're now at levels that are dangerously low relative to the number of outstanding contracts. When industrial users start demanding physical delivery, when they start draining the registered silver out of the COMEX vaults, it creates a supply squeeze. The COMEX has to scramble to find physical silver to deliver, and if they can't find it, they have to default on their contracts. A COMEX default would be catastrophic for the paper silver market because it would destroy the illusion that paper contracts are backed by physical metal. It would cause a loss of confidence in the entire futures market, and it would send the price of physical silver to the moon as buyers scramble to secure real metal. Now let me talk about the decoupling that's happening right now. Normally, silver and gold move together. When gold goes up, silver goes up. When gold goes down, silver goes down. They're both precious metals. They're both safe havens, and they're both influenced by the same macroeconomic factors like inflation, interest rates, and the strength of the dollar. But right now, we're seeing silver decouple from gold. Gold is pausing at $5,180, consolidating, catching its breath after a massive rally. But silver is breaking out, pushing through $87 and showing strength even though the US dollar is strong. This is highly unusual, and it's a sign that something fundamental is changing in the silver market. The reason for this decoupling is industrial demand. Gold doesn't have the same industrial demand that silver has. Gold is used in some electronics and in dentistry, but it's primarily a monetary metal. Silver, on the other hand, is industrial first and monetary second. So when industrial users panic and start hoarding silver, it creates upward price pressure that's independent of what's happening with gold. The industrial demand is overpowering the paper market manipulation. The bullion banks can short sell paper contracts all day long. But if industrial users are buying physical metal and taking it off the market, the paper shorts become irrelevant. The physical market is taking over. And the physical market is saying that silver is worth a lot more than $87. Now let me talk about the strong dollar, because normally a strong dollar is bearish for commodities. When the dollar is strong, it takes fewer dollars to buy the same amount of a commodity, so the price in dollars goes down. We're seeing this with some commodities like copper and oil, which have been under pressure due to the strong dollar. But silver is ignoring the strong dollar. Silver is going up even though the dollar is strong. This is another sign that industrial demand is overpowering macro factors. Industrial users don't care about the dollar. They care about securing the silver they need to manufacture their products. If the price goes up, they're still going to buy it because the alternative is shutting down their production lines. Let me give you a specific example of what's happening. Let's say you're a solar panel manufacturer. You need silver paste to manufacture your panels. Without silver paste, you can't make panels. If the supply of silver is tight and you're worried about not being able to get silver in 6 months, you're going to lock up as much silver as you can right now, regardless of the price. If silver is $87 an ounce and you need 100,000 ounces, that's $8.7 million. But your annual revenue is probably in the hundreds of millions or billions of dollars. The cost of the silver is a rounding error compared to the risk of not being able to manufacture your product. So you're going to buy the silver, and you're going to pay whatever price is necessary to secure it. This is the mentality that's driving the industrial panic right now. Now let me talk about the tariffs, because this is adding fuel to the fire. The United States is imposing Section 301 tariffs on imports from China, Europe, and other countries. These tariffs are targeting a wide range of goods, including electronics, vehicles, machinery, and industrial components. The tariffs are designed to protect domestic manufacturing and to punish countries that the U.S. believes are engaging in unfair trade practices. But the unintended consequence of these tariffs is that they're creating massive uncertainty about the future cost and availability of industrial materials. Companies that rely on global supply chains are now scrambling to secure their supply before the tariffs make everything more expensive. Silver is caught in the middle of this because silver is mined all over the world. Mexico is the largest silver producer, followed by Peru, China, Russia, and Australia. If the U.S. imposes tariffs on imports from these countries, or if these countries retaliate with their own export restrictions, the supply of silver to the U.S. market could be severely constrained. U.S. manufacturers are aware of this risk, and they're stockpiling silver now while they still can. This stockpiling is creating additional demand on top of the already tight market, and it's pushing prices higher. Now let me talk about what's happening at the retail level, because this is where the rubber meets the road. Retail investors buy silver coins and bars from dealers. The dealers get their inventory from the mints. The mints get their silver from refiners. The refiners get their silver from mines and from recycling. When industrial users are hoarding silver, when they're locking up supply with long-term contracts, there's less silver available for the refiners to sell to the mints. The mints can't produce as many coins and bars. The dealers don't have as much inventory. And the retail investors who want to buy physical silver find that premiums are rising and availability is declining. We're already seeing this happen. Premiums on silver eagles and other popular coins are elevated compared to historical norms. Delivery times are getting longer. Some dealers are reporting that they're having trouble getting inventory from the mints. This is the early stage of a supply squeeze, and it's going to get worse as the industrial panic intensifies. When multinational tech and defense corporations decide to hoard physical silver to survive a global trade war, the retail supply vanishes overnight. The dealers will be sold out, the mints will have year-long waiting lists, and the premiums will skyrocket into triple digits. We're talking about premiums of $20, $30, $40 over spot or more. Let me talk about the military and defense angle, because this is another source of demand that people aren't paying attention to. Silver is essential for defense technology. It's used in missiles and radar systems and electronic warfare systems, in satellites, in drones, in communications equipment. The U.S. military and defense contractors are ramping up production due to the wars in the Middle East and Ukraine and the tensions with China. They need massive amounts of silver, and they're competing with industrial users for the same limited supply. The Pentagon doesn't negotiate on price when it comes to securing materials for national defense. They pay whatever is necessary to get what they need. This is adding another layer of demand pressure on the silver market. Now let me talk about what the paper market is doing, because this is where it gets interesting. The bullion banks that manipulate the silver market through paper short selling the COMEX are losing control. They can short sell as many contracts as they want, but if industrial users are buying physical metal and taking delivery, the paper shorts become meaningless. The paper market is a casino where you bet on price movements without actually touching the metal. The physical market is where real buyers and sellers exchange real metal for real money. And right now, the physical market is diverging from the paper market. The paper price says $87, but the physical price, when you account for premiums and availability, is much higher. This divergence is going to widen, and eventually the paper market is going to collapse because people will realize that paper contracts are not backed by physical metal. Let me give you some numbers on the COMEX vaults to show you how tight the situation is. As of the most recent data, the COMEX has about 300 million ounces of silver in its vaults, and of that, only about 80 million ounces is registered and available for delivery. That sounds like a lot. But remember, there are hundreds of thousands of open contracts, each representing 5,000 ounces. If just a small percentage of contract holders stand for delivery, the COMEX will run out of registered silver. And once the registered silver is gone, the COMEX either has to convert eligible silver to registered, which requires the permission of the owners, or they have to default. A default would be the end of the paper manipulation game. Now let me talk about what China is doing, because China is always a wild card in the commodities market. China is the world's largest manufacturer of electronics, solar panels, and electric vehicles. They consume massive amounts of silver, and they're also hoarding silver strategically because they understand that silver is a critical material for their industrial base and for their military. China has been accumulating silver reserves for years, and they've been restricting exports to ensure that their domestic industries have access to the silver they need. If China decides to impose a formal export ban on silver, or if they ramp up their hoarding even further, it will remove a significant amount of supply from the global market and push prices even higher. Let me talk about the opportunity that exists right now for retail investors. You have a very narrow window to act. Right now, you can still go to a dealer and buy physical silver. You might have to pay a premium. You might have to wait a few weeks for delivery, but you can still get it. But when the industrial panic becomes mainstream news, when the media starts reporting that there are shortages, when the average person realizes what's happening, there's going to be a rush to buy physical silver, and the supply is going to evaporate. You need to front-run this industrial panic and secure your physical ounces locally before the premiums skyrocket into triple digits. This is not like buying stocks or bonds where you can click a button and buy at any time. Physical silver is a finite resource. There's only so much available at any given time. When demand exceeds supply, the price goes up and the availability goes down. If you wait too long, you won't be able to get physical silver at any price. You'll be stuck holding paper dollars that are being inflated away, or you'll be stuck with paper silver contracts that may not be backed by physical metal. The only way to protect yourself is to own physical silver to take delivery and to store it securely. Now let me address the people who say that silver is too volatile, that it's too risky, that you should just buy gold instead. Gold is great. I own gold. I recommend gold as part of a diversified precious metals portfolio. But silver has characteristics that gold doesn't have. Silver has industrial demand that creates upward price pressure independent of monetary factors. Silver is more affordable for retail investors, which makes it more accessible. Silver has more upside potential on a percentage basis because it's starting from a lower price. And silver is more scarce above ground than gold because most of the silver that's ever been mined has been consumed in industrial applications and can't be recovered. Gold, on the other hand, mostly sits in vaults and jewelry and can be recycled. Let me talk about the psychology of this market, because understanding the psychology is critical. Most people are not paying attention to silver. They're focused on gold, on Bitcoin, on stocks, on real estate. Silver is under the radar. It's not sexy. It's not exciting. It doesn't get headlines. But the smart money knows that silver is where the opportunity is. The smart money is quietly accumulating physical silver while everyone else is distracted. And when the industrial shortage becomes obvious, when the panic sets in, the smart money will already be positioned, and everyone else will be scrambling to catch up. Let me give you a historical example of what happens when industrial users panic and hoard silver. In the early 1960s, the U.S. government was using silver in coins. The price of silver was artificially suppressed at $1.29 an ounce by the U.S. Treasury, which would sell silver from its stockpile to keep the price down. But industrial demand was growing due to the expansion of electronics manufacturing and photography. Industrial users started hoarding silver because they were worried that the government stockpile would run out and the price would spike. And that's exactly what happened. By 1965, the U.S. government stopped using silver in coins because the industrial demand had driven the price above the face value of the coins. The price of silver went from $1.29 to over $50 by 1980. That's a 38x move. We're setting up for a similar dynamic right now. Now let me talk about what you should be doing right now. You need to be buying physical silver. Not paper, not ETFs, not mining stocks, but physical coins and bars that you can hold in your hand. Go to your local coin shop, call a reputable online dealer, buy silver eagles, buy silver maples, buy silver rounds, buy silver bars. Take delivery, store it securely, and hold it. Do not try to trade in and out of silver. Do not try to time the market. Just accumulate physical ounces and wait for the industrial shortage to push the price higher. Every ounce you buy today at $87 is an ounce that could be worth $150, $200, $300, or more in the future. Let me talk about the timeline because people always want to know when this is going to happen. The industrial panic is happening right now. Companies are hoarding silver as we speak. The COMEX vaults are being drained as we speak. The supply squeeze is intensifying as we speak. My estimate is that we're looking at 6 to 12 months before the shortage becomes obvious to the mainstream. But it could happen faster if there's a major catalyst like a COMEX default, a geopolitical shock, or a major industrial user announcing that they can't get the silver they need. You don't have time to wait and see. You need to act now while physical silver is still available. The physical silver squeeze is accelerating, and the COMEX default is inevitable. You need to hit the subscribe button and turn on the bell notification right now so you receive my emergency broadcast the exact second the industrial shortage becomes mainstream news. This is not a suggestion. This is a command. Your financial survival depends on being informed and being positioned ahead of the crowd. Subscribe now, turn on notifications, and prepare for the silver squeeze. If you want to understand exactly why these supply chains are breaking and how the global energy crisis is mathematically guaranteeing hyperinflation, you must click the video on your screen right now. I expose the historic 400 million barrel oil dump cover-up. Do not wait. Click right here and I will see you in that video.